Hi, I'm Rick Kaler. Thanks for joining me. Buy low, sell high. That was my simple approach when I was a smart young investment advisor. I would pore over a company's balance sheet, earnings statements, and forecast returns, and then buy those companies that were bargains. I'd kick back and wait for my gains to roll in. More times than not, they did eventually. The problem came with the not and the eventually. Only a minority of my picks were nots, but those that were nots, the losses were enough to counter the majority that did go up in value and had a pretty negative impact on my bottom line. Even more frustrating, some of my nots turned into gains eventually after I sold them. My investment returns were similar to findings from Dalbar Inc., a financial services research firm. Dalbar's studies have shown that average active investors barely beat inflation over the long term. They significantly underperform investors who put their money in an index fund of stocks and left it alone. Not much exciting about that. Well, so much for my early investment brilliance. Over the past 40 years, I've learned that with every passing year, I know less than I thought I did the year before. I've proven to myself I have no idea where any market is going tomorrow, next month, next year, or in the next 10 years. This awareness has led me to become increasingly passive in my investments. In passive investments, rather than trying to time the buying and the selling of winners and losers, you instead buy a representative sample of the entire market. This is possible in any market, whether it's bonds, stocks, real estate, investment trusts, or commodities. These are all markets. You simply buy mutual funds and exchange traded funds called ETFs that have the name of index in their name, called index funds. The two biggest benefits of passive investing are cost and diversification. When we think of cost, index funds have incredibly low costs, with annual fees as low as 0.1%. Contrast that with the average equity fund that costs around 1.5%, 15 times more. According to research, 97% of active mutual fund managers don't beat the index over 20 years. Even the 3% who do beat the index must beat it by more than the 1.5% fee they charge in order for their investors to come out ahead. Think of that. When we're thinking of diversification, the number of smaller stocks that I own, I find that the more my fortunes are tied to those few companies. So the less stocks I own, the more I'm dependent upon the returns coming from them. It's kind of the old adage, don't put all your eggs in one basket. By owning index funds, I own hundreds or thousands of securities. And while I'll never hit a home run, I also will never strike out. My returns will be average. Think of this. Investing may be one of the few professions where being average puts you in the 97th percentile of all investment managers. Now, not all of my peers agree with this philosophy. Many very smart investment advisors jumped off the passive investment bandwagon after 2008 and returned to what's called tactical asset allocation, which is just another name for timing the markets. A noted investment advisor, Harold Yavinsky of Yavinsky and Katz, addressed this issue at a conference last year. After the 2008 crisis, his firm hired researchers to evaluate whether they could find any tactical strategies that would have avoided the crisis. They found some that in hindsight would have worked. Yet he didn't feel those strategies could be comfortably applied looking forward. So instead, the firm decided to add a 20% allocation to non-correlated alternative investments, something that we've done at KFG since the late 90s. In other words, they increased their clients' diversification. So the bottom line is that passive investing actually gives you more control. It allows you to focus on aspects of investing that you can control, namely reducing costs and taxes. It frees you from worrying over what you can't control by trying to beat the market. Thanks for joining me.